In the current economic landscape, central banks worldwide are adopting aggressive measures to combat inflation, potentially steering the global economy towards a severe recession. Adding to the complexity is the looming specter of the U.S. national debt, which continues to swell, casting doubt on the future stability of the dollar. In light of these challenges, investors are increasingly seeking alternative assets capable of providing a hedge against economic volatility. One such asset with a long-standing reputation for preserving value is gold. Throughout history, gold has served as a reliable store of wealth during times of economic uncertainty, making it a compelling option for investors looking to safeguard their portfolios against market turbulence and currency devaluation. As central banks raise interest rates in an attempt to curb inflation, the risk of a global recession intensifies, prompting investors to explore avenues for protecting their wealth. The burgeoning U.S. national debt further exacerbates concerns about the long-term viability of fiat currencies, particularly the U.S. dollar. In response to these economic headwinds, gold emerges as a potential hedge against depreciating currencies and financial instability. Its intrinsic value and status as a tangible asset make it an attractive option for investors seeking to diversify their portfolios and mitigate risk amid uncertain economic conditions. Therefore, a closer examination of gold's role in wealth preservation becomes imperative as investors navigate the complexities of the global recession and the U.S. debt crisis. Recessions are periods of economic contraction characterized by a decline in GDP over 2 consecutive quarters, signaling widespread financial distress. While recessions can occur independently of financial panics, these events represent extreme fear-driven scenarios where the desire to liquidate assets overrides all other considerations. The severity of panics can vary, as demonstrated by contrasting examples such as the 2008 financial crisis with the milder panic of 1987, which was more contained in its impact. Despite their differences, both recessions and panics underscore the inherent volatility of financial markets and the need for investors to navigate these uncertainties with caution. In the midst of economic turbulence, investors often seek refuge in safe haven assets, with the U.S. dollar historically serving as a bastion of stability during times of crisis. This flight to safety phenomenon has been a common occurrence, as investors flock to the dollar in search of security. However, in today's interconnected global economy, the dollar's resilience to shocks may be less assured, particularly amidst the looming threat of the U.S. debt crisis. As the specter of escalating debt casts doubt on the dollar's long-term stability, investors are prompted to reconsider the traditional role of the dollar as a safe haven asset, potentially turning to alternative stores of value like gold to hedge against currency depreciation and financial uncertainty. Inflation, often dubbed the Hydra of economic challenges, presents a multifaceted threat stemming from both supply and demand dynamics. On the supply side, disruptions to global supply chains, resource scarcities, and bottlenecks have led to increased production costs and supply shortages, exerting upward pressure on prices irrespective of central bank policies. Recent events such as semiconductor shortages, the fertilizer crisis, and port congestion serve as poignant examples of these supply-side constraints, highlighting the intricate interplay between global economic forces and inflationary pressures. Meanwhile, on the demand side, shifts in consumer behavior contribute significantly to inflation dynamics. Instances of panic buying, the anticipation of future price hikes, and rising wage demands fueled by inflationary expectations create a self-perpetuating cycle of increasing demand and prices. This demand pull inflation exacerbates inflationary pressures, further complicating the economic landscape. Despite the Federal Reserve's role as a guardian of price stability, its toolkit, primarily comprising interest rate adjustments, is more effective in addressing demand pull inflation than supply-side inflation rooted in real-world constraints. While interest rate hikes can help temper excessive consumer spending and curb demand-driven inflation, they are less effective in addressing supply-side challenges. The limitations of monetary policy become starkly evident in the face of supply-driven inflation, where factors like disrupted supply chains and resource scarcities remain beyond the Fed's immediate control. Consequently, policymakers are faced with the daunting task of devising holistic strategies that address both supply and demand dynamics to effectively mitigate inflationary pressures and restore economic stability. The repercussions of inflation reverberate throughout the economy, often culminating in a precarious balance between recessionary pressures and erosive effects on purchasing power. High inflation rates can initiate a cyclical downturn as consumers grapple with soaring costs for essential goods such as gasoline and food, prompting them to curtail non-essential spending drastically. This paradoxical dynamic, where inflation inadvertently fuels recessionary tendencies, underscores the delicate equilibrium between consumer behavior and economic growth. Moreover, while nominal wages may experience an uptick during periods of inflation, the corresponding decline in purchasing power negates any perceived financial gains for workers. Despite the illusion of increased earnings, individuals find themselves unable to afford the same standard of living due to the relentless erosion of the currency's value, thus exacerbating economic strain. In navigating the complex terrain of inflation, central banks like the Federal Reserve are confronted with a profound dilemma: how to combat inflation without precipitating a recession. Often, the Fed responds to mounting inflationary pressures by implementing tight monetary policies, including interest rate hikes, in an attempt to curb spending and mitigate inflationary forces. However, such measures risk tipping the delicate balance, potentially triggering a recession characterized by higher unemployment rates and sluggish economic growth. This conundrum underscores the inherent trade-offs faced by policymakers, where the pursuit of price stability may inadvertently come at the expense of broader economic stability, perpetuating a cycle of economic uncertainty and volatility. The Bretton Woods system, established in 1944, laid the groundwork for global monetary stability by pegging currencies to the US dollar, which was in turn backed by gold at a fixed rate of $35 per ounce. At its core, this system provided a stable foundation for international trade and finance, fostering economic growth and cooperation among nations. Additionally, the International Monetary Fund, IMF, was instituted as a crucial component of Bretton Woods, designed to act as a swing lender that provided temporary assistance to countries experiencing trade imbalances. By offering financial support, the IMF aimed to facilitate necessary adjustments in national economies and deter abrupt currency devaluations, thereby promoting stability in the international monetary system. However, over time, the IMF underwent a notable transformation, deviating from its original mandate and becoming increasingly politicized. This evolution led to a departure from its core mission of maintaining monetary stability, as the IMF began offering large loans with stringent conditions to nations, such as Ukraine, that often failed to meet the initial criteria. This mission creep compromised the IMF's effectiveness in stabilizing the global economy, as its interventions became entangled in geopolitical considerations and conditionalities that sometimes exacerbated economic challenges rather than alleviating them. Thus, while the Bretton Woods system represented a landmark achievement in international monetary cooperation, the IMF's departure from its stabilizing purpose underscores the complexities and pitfalls of managing the modern global financial landscape. Gold has historically served as a safe haven asset during times of economic uncertainty and geopolitical instability, owing to its intrinsic qualities such as limited supply, tangible nature, and lack of counterparty risk. Throughout history, gold has maintained its value, and during previous recessions and periods of high debt, investors have turned to gold as a reliable store of wealth. Moreover, gold's appeal extends beyond its role as a safe haven. It also acts as a hedge against currency devaluation, particularly in the context of the escalating U.S. debt crisis. As the national debt continues to grow, there is a heightened risk of erosion in trust towards the U.S. dollar. In such a scenario, investors may increasingly view gold as a hedge against potential currency devaluation and a means to preserve their wealth. However, it's essential to recognize that investing in gold carries its own risks and uncertainties. While gold has demonstrated resilience over time, its price can still fluctuate like any other asset, and past performance is not necessarily indicative of future results. Therefore, investors considering gold as part of their portfolio should conduct thorough research, assess their risk tolerance, and potentially seek professional advice to make informed investment decisions aligned with their financial goals and circumstances. In times of economic uncertainty, diversifying one's investment portfolio becomes paramount to mitigate risks and safeguard against potential downturns. With the looming threats of recession, inflation, and currency devaluation, it's essential for investors to explore alternative assets like gold and silver, which have historically acted as safe havens during turbulent economic times. Educating oneself on the dynamics of precious metals investments and understanding their potential role in a diversified portfolio is crucial. By allocating a portion of their investments to gold and silver, investors can enhance portfolio resilience and protect their wealth from the impacts of market volatility and economic instability. For those interested in delving into gold and silver investments, resources like National Gold Group can serve as valuable starting points for exploration. National Gold Group offers informative materials and expert guidance on precious metals investments, empowering investors to make informed decisions aligned with their financial objectives. Moreover, their fee waiver programs and commitment to customer service ensure a transparent and supportive investment experience. By leveraging such resources and taking proactive steps to diversify their portfolios, investors can better position themselves to navigate the uncertainties of the current economic landscape and preserve their wealth for the future.